After a short trading week following Thanksgiving, we had a massive announcement from the Fed and the market reacted. Let's talk with Riz on whether this is sustainable or not. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our weekly market recap webinar where we take a look at the market, see what's been going on to keep you informed. And tonight I have the man who has his finger on the pulse of the market. That is Riz. How you doing tonight, Riz?
Doing good, Chris. Yourself?
I cannot complain. It's a beautiful day. As they say, every day above ground's a beautiful day. We got a great crowd here tonight. I'm really excited. And if you are watching this replay and you are not subscribed to our channel, please make sure you click that like and subscribe button down below. Leave a comment. Let us know what you think. Let us know if there's something you would like us to cover on webinar in the future, because we'd love to hear your feedback on that. But yeah, pretty big week for the S&P 500. After a short trading week following Thanksgiving, obviously there was no trading on Thursday, and then Friday was only a half day on Black Friday. And then, Monday and Tuesday, we kind of had a little bit of dribbling down here, for lack of a better term, because everybody was waiting for the Fed announcement, the Fed discussion, and, well, we had it. And, from what I understand, and is basically saying like, well, inflation is looking better, so maybe we aren't going to be hitting those interest rates as hard in the future as we have. And everybody thought this was fantastic. We absolutely blew through the 200 simple moving average like it wasn't there. But look what we have respected. We have respected the downtrend line. Now, I will say we are between a rock and a hard place right now in the S&P 500. We are between the 200 simple moving average and this downtrend. And I'll say that, if this euphoria continues, I think we could see a push a bit higher. But Riz, what do you make of all this in the Fed announcement? I mean, do you think this is too early for them to start, cooling off rate hikes, or do you think that this is warranted?
Yeah, so this is an interesting phenomenon we have ourselves in where, this has happened in the past a few times in recent history where we've been in a hiking cycle. We've been in the market where the rates are going up, not at this pace of this year, but they have been going up slowly. For example, in 2018, up until 2019, we were seeing, rates go up 25 basis points, once every couple meetings. Not like now, where every meeting they're doing 25, 50, and even 75 basis point hikes. So this is a very, very different scenario. But if I can kind of make some, I would say, correlation, we do know at some point in every hiking cycle, the Fed does slow down the rate hikes. And then what do they do after slowing down the hikes? They pause, right? They will do a pause. And that's what the market is really trying to feel out. Powell has said, they're going to slow down their hikes. Um, Now, that doesn't mean they're going to stop, right? So that's a very important clarification. I mentioned that last week as well. It doesn't mean they're stopping. It just means they're slowing them down. So by that, if we take them at their word, that means instead of doing a 75 basis point hike like they did last time, they may most likely do a 50 basis point hike, or even there is a chance that they might do a little bit more of a dovish approach, which is a 25 basis point hike. I personally lean in the camp that they're going to do a 50 basis point hike. Um, but the thing that threw a spanner in the works was just job numbers. So um, we had job numbers and unemployment come in, and what happened then was, whoa, the market was like, oh my God, the job market is very strong. It added more jobs. And you would think that in an economy that should be weakening, because the Fed is trying to weaken employment. Remember, I said this, I can't remember if it was last week or a few weeks back. So I said, the Fed won't outright say this, Powell won't outright say this, but they're trying to decrease, the amount of jobs that are out there, and they're trying to increase unemployment, right? They're trying to make or have more people be unemployed. For lack of a better way to explain it, they want more people out of work, and that's because obviously less people working, less money coming in, slow down in spending, slow down in spending equals slow down in inflation, demand, and as a result, a weakening economy there we go, right? So this is how you cool down the economy, and this is a vital part of it. It's important to have an economy that does cool off a bit. You can't have it running hot. It's going to melt. It's going to blow up. So when I see the Fed in a situation like this, I always think, okay, well, when are they going to stop? When are they going to slow down? And the market thinks the same thing. When are they going to slow down? Well, Powell kind of said slowing down. Then the next question is, when are they going to pause, right? Or stop raising rates? Doesn't mean they're going to automatically decrease. People just think raising rates and decreasing rates. They don't think about pausing. So there could very well be a pause. Maybe they do a 50 basis point hike this month. Remember, that's in 10 days. Approximately 10 days is the next meeting, I believe on the 13th, right? So that's the next Fed decision. Conveniently, a few days, let's just say a week before um, Christmas. So that's something to keep in mind. I feel like next year, and the market feels the same way, they are going to pause. Obviously, I think in the latter, I would say the first half of the year. Um, that's where I think that whole pivot might come. And I mentioned that in Elite. I won't go into the details here, but that's where that pivot might come. And I think based on that little chart, that little graphic we showed last time around, Chris, was that that's where we could see that change in the market. And people would think, well, the Fed stopped raising rates. That's the pivot. They might start decreasing. That's the pivot, right? And as a result, the market should recover. Markets like lower interest rates. Well, historically, when that does happen, the market usually makes the next leg lower. So that is what I'm kind of trying to anticipate, prepare ourselves over. And here, perfect, Chris. Right on cue. Brought this, chart here, and I explained this last time around in the last week's webinar. So you can, I'm not going to re-explain it, but you can go over that explanation last time. Um, so yeah, but anytime the Fed pivots, we usually see a lower, the market going lower after that point. So it'll be interesting to see, and that time is going to be. I mean, I can't guarantee it, but there's a 90+% probability that it's going to be next year, right? So we'll be keeping an eye on things. We'll be keeping you guys updated, but something to think about as we head into the end of the year.
I don't know. For me personally, it just feels way too simple. It's like, we raise rates for a year and then, automatically inflation is cured. And, it seems like a really just like, okay, yeah, that's it. It's all better. But I feel like the problem is a bit deeper than that. I mean, can they really take care of this with just raising interest rates for a little more than a year, or is it going to take more than that?
Yeah, I think you know what, their whole point is, okay, we need to get inflation in check. I personally feel like inflation can continue to run. It remains to be a little bit more sticky than they even thought. I think this year raising rates made sense. Next year they're going to kind of shift their agenda, their mandate a little bit, and maybe go a little bit more neutral. This year was all about being aggressive and acting and doing something, whereas in 2021 they did nothing. And they admitted that. They admitted that themselves. That they were kind of asleep at the wheel. They thought it was transitory, inflation was transitory, and they won't need to act. But this year has been all about the Fed and rate hikes, right? That's really what the main thing has been, um, along with obviously inflation. So next year, the theme will be very different. I am sure you the theme will be different. Next year will be all about the pivot and then, how the economy is doing. The Everyone was so focused on inflation this year. Um, and as a result, how the Fed's reacting. Next year is all going to be the health of the economy. How's unemployment doing? You know, are rates going to be paused? Are they going to be even decreasing? Those are the things where I feel like, you know, where we'll have to put our attention to. And in regards to, is it that simple? No, I mean, it's always a moving goalpost. It's always this moving target. We're going to have to keep uh, an eye on, and we're always going to have to be cautious and react and adjust, right? And that's the beauty of markets. Whether people like it or not, the fact of the matter is always in flux, always changing.
Well said. Yeah, we're definitely going to have to keep an eye on the next couple weeks here as we go into that new Fed rate decision on the 13th. Obviously, typically trading in December is a little bit, slower. I would say usually the market isn't making huge moves like this in December, but we'll have to see going into that decision on the 13th. But let's take a look here at the different market sectors. We've seen this nice melting up of healthcare and utilities, really been pushing back up above that lovely zero line. So these, two have finally made the push over into the positive here coming in towards the end of the year. Energy is just continuing to steamroll right now, and everything else is pretty much in the tank. Financials slightly overperforming the market right now, which is down about 15%, 14.5%. While tech and real estate really just getting slaughtered this year. It has been a bloodbath, to say the least, unless you're in the energy sector. But I would say nice gains here over the last couple months in healthcare and utilities. I mean, that's definitely a nice sign looking forward, I would think.
Yeah, yeah, I agree with you. I feel like right now we're taking a bit of a wait and see approach. I will say, I mean, people in elite already know this. Um, but just a little bit more value add for people that are not in elite and watching this. I am short uh, the energy sector XLE right there, right? So we took that short this week, and right now it's just slightly in the red, but it's early. This is a trade that I'm okay with holding for some time, letting the market mean reversion play out as well, and seeing eventually that divergence between oil prices and energy companies, which usually ends up being large oil producers, kind of come back down to earth because they're pretty um, overextended and they remain so. So it'll be interesting to see how that trade goes.
Yeah, we'll definitely have to wait and see how that pans out. I will say, yeah, energy seems to be really way too high. I mean, especially when you take a look at oil here that has, like we talked about last week, really kind of reverted back to where it was at the beginning of the year. If I switch this to, year to date, you'll see right here, right around this 76 area, that's where we started the year on oil. And, we kind of came down here towards the end of last week. We kind of bounced off of that pretty nicely. So, moving forward, I know, Riz, you always are keeping an eye on oil. That is your thing. I've, in previous webinars, probably a long time ago, referred to you as the oil tycoon, but really just kind of, we seem to be a little bit range bound right now between this 85 and 76 area. Now, I've heard a lot of talk about, like, price caps on Russian oil and things like that. Is that going to play a part in the price of crude, or is that pretty much only going to potentially affect the Russians?
Yeah, it will definitely impact somewhat, not the biggest of the deal in terms of impacting price. And in fact, it's funny you mentioned that because just today Russia countered with saying that no, we obviously, I mean, it was bound to happen, but they did officially say that what, we're not in support, or we're not gonna try and comply with the $60 cap on our oil. Um, so I mean, it wasn't surprising, but hey, that is a development in that story. As far as prices, we also know that OPEC. I think they're meeting in a couple of days, or they're meeting tomorrow or something. I can't be exactly sure of the day, but they are meeting very soon. And it's again, we don't know what's going to happen, but we do have some predictions, and probabilities are that they're probably going to keep things the way they are with a potential, uh, you know, decrease in supply. So maybe a supply cuts. They've hinted at it, but I don't think they're going to make that call this meeting, and they'll probably leave that for the next one. So there's that coming in as well. I feel like 75 to 85 is that kind of sweet zone for oil. A strong break below 76 would indicate that we go a bit down about 70. But for now, in my view, no kind of trade in oil directly just yet.
Now, gold is making some moves here as of late. Obviously, we had a big push up here earlier in the month, and then it seems like we closed pretty high, right around this 200 simple moving average. Is this a sign that the dollar's starting to weaken, or is gold just becoming more in demand?
Yeah, so gold. I don't think it's necessarily demand. It's just institutions and traders kind of just arbitraging this. And I think, yeah, it's coming up. We do know there has been a little bit of a weakness in the U.S. dollar, so that's important. Um, we we can assume it's really just technicals at this point. There isn't much change in regards to inflation or economically where I feel like it warrants gold prices to kind of run up. But it has, it's pulled back all the way to 1640, and then it just rallied, pulled back a little bit, and now it's had a nice bullish breakout as well on Thursday onwards. So it's holding that nearly 1798 area, nearly $1,800 an ounce. And which also is, as you mentioned, is that 200-day moving average. Personally, um, you know, no trade in gold, sorry, for me. And I'm not looking to do so anytime soon. But it is important to kind of just keep an eye on it. And you're right that the U.S. dollar can impact the spot price for gold. We've seen crypto here just kind of sitting here idle, really, with the whole FTX fiasco still playing out. I find it's absurd that SBF, Sam Bankman-Fried or Fried, just should get fried. He should be in jail. And I feel like the fact that he did, just recently he was on a panel for some getting his views on the whole what's happened at some deal book conference in New York. So he wasn't there live in person, but he was there um, via Zoom. So I find it comical that they're interviewing and having a discussion and cracking jokes when really they should be doing that from inside of a jail cell. Um, but here we are, right? So quick, crypto just continues to languish. It is what it is, really. Not something on my radar that I'm planning to make a trade on or position in. Um, but with that said, on to more interesting things. I do have a few trade ideas for you guys. Especially those of you in Elite, but also those of you watching outside of Elite. To recap here, so a couple of ideas I have for you, I'll share. Number one being Crowd, CRWD, that's CrowdStrike. This is a data security type of company that released earnings last week. They did good, but they had weaker guidance and they just got butchered. They were down significantly. You can see that gap down. They did recover a bit post earnings. But this is one that sets up for a good risk reward play. I have been waiting. I didn't want to catch the knife on this post earnings, so I waited. But as you can see, it's kind of gone back up a little bit from the post earning lows. So I'm waiting to see if the market does pull back a little bit. Maybe this will with it. But right now, no trade. But it is something I am eyeing. That 120 level seems to be a good solid key area, right? So if I go long on this, just for an example, I'd want to see if we can run it up to around 135, 140, with probably a stop being a little below 120, right? Just as a good risk reward there. But that's right now. We don't exactly know how things will happen on Monday, but that would be my tentative plan. All right. Another stock, and this one we all know and heard of and traded, is Amazon, AMZN, and this one just not performing as well alongside the market. The market recovered quite a bit over the last couple weeks, but Amazon's just still relatively weak from a relative strength standpoint. So this one's also on my radar for a potential long, with kind of resistance coming in around the $100 mark, right? As Chris has already drawn that line. Uh, so this is a potential setup I'm keeping an eye on heading into this week and maybe the week after. Um, in regards to semiconductors, I have a position in AMD. Um, People in Elite already know this, but NVIDIA is another one that is something. I mean, another amazing company in semiconductor that's been doing really well, moving well with the market, and has quite a big of quite a big rally over the last month and a half. From around 120 area to now. The question is that okay, well, they're a little bit overbought right now as per the RSI. So I've been waiting and seeing, do we get a little bit of a dropping down to that area of what is that 50-day moving average, Chris? 50-day
So yeah,
moving average.
the orange line is the 100, and then the teal line is the 50.
Okay, yeah, there it is. Yep. So the 100 moving average there, and I think that what price is that? 150, I think. Yeah, I think it's 150. Yep, 150.76 is where the moving average is. The 100. So I want to see if we can get a little bit lower before getting in there. But again, I'm waiting. They also had that dividend. On what, Thursday? I think it was Thursday. Yep, it was Thursday. So interesting to see. So those are three potential trade ideas for you guys to think about, and of course, in Elite, you will know what I'm thinking and any moves I'm making the moment I do make them.
All right, Nick has a question here. He says that the S&P 500 closed above the 200 simple moving average twice, but it's sitting right on our trend line, as we mentioned earlier. Technically, what has more weight, closing above the 200 and start pushing upwards, or hitting the trend line that has proven to be true a few times and descends down? My opinion on this, and I'll let Riz answer. I think a lot of it has to do with sentiment. Technicals are just technicals. They are, what we look at to, give us an idea, but it's not like it's set in stone. It's not the end all be all of everything. There's more to it than just technical analysis. But Riz, I'll let you tackle that.
Yeah. So when it comes to the S&P 500, obviously it's the broader market, many different moving pieces across it. But from a technical standpoint, to further on to what Chris said, the question you asked, so both are true. If we get a nice break above the 200, and right now I wouldn't say it's confirmed yet. We need a little bit more price action, a little bit more pricing data. And because this is the daily chart, we need a few more days to go by above that 200 for me to say, okay, the 200-day moving average is a potential good support. Right now, it's hard for me to really say that. I wouldn't say that just yet. And we've also seen that, back in March, almost April, you could see that the market did go past the 200-day moving average, and it stayed there for a few days, and then it made its way back lower, right? Again, from a pure technical standpoint, um, the same could occur, right? But if it doesn't, and let's say the market continues to rally, breaks above this teal downtrend as well, and let's say it goes above 4,100, that would tell me, okay, you know what? We might be at a point where the markets move past the 200-day moving average. Maybe it continues to run, and we could see higher. We could see 4,200, right? And 4,300 level is the next hard resistance area. So I wouldn't be too quick to say we're going to see 4,300 right away, but if we have a strong break above 4,100, we could see 4,200 level next. One thing that kind of gives me some pause and some room for concern apart from these technicals is that we are in December. We know December is a slow month from a volume, from a participation standpoint. Okay, this is a fact. We know that many institutions, trading desks, uh, you know, whatever, they're not trading as much. Some of them are off. They're on holidays, yada yada. So this is applicable to pretty much the broader market as a whole, and we see that in volume. So I'd be very careful with drawing hard conclusions in December solely off of technicals, right? But it's a good question. If we do, on the flip side, get a rejection, so we see this week the market pull back lower. So essentially bounce down from that 200-day moving average. Maybe it goes back to 4,000, below 4,000, maybe 39.50. That tells me, okay, that's a hard rejection of the 200-day moving average, and we could be in for 3,900, 38.50. Okay, not immediately, but that's how we want to go about it, right? And this is what we use to kind of theorize, right? It's not set in stone, as Chris said, and these are ultimately technicals, meaning we're just visualizing price movements. Price is moving because of many, many variables. Could be the Fed, could be data, economic data, could be geopolitical events, could be other asset classes. Even when we see, uh, oil move in a certain way, when we see treasuries move in a certain way, that impacts markets. We see yield curves, you know, change. That impacts markets. We see bond rates change. That impacts markets. So technicals, I go over this in the master class. Technicals is just a way to visually uh, interpret and guide us, right? Many people are so stuck in technicals that they think technicals drive the market. It's actually the other way around. Um, Technicals are just a good way to visualize it, give us a little bit more context, right? And make more sense of this always complex moving mechanism that is the financial markets.
Well said. Nick has one more question. Do we think Walmart looks good for a short? Let's take a look here. Well, Walmart has definitely been on quite the bull run here since earnings. Looks like earnings were pretty solid. Obviously, we're going into the holidays here. Um, though, it does seem like we are, rejecting a little bit here around the 155 area. And obviously, we're very far extended from the moving averages, but I would have a little bit of a hard time shorting this with those earnings results. Riz, what are your thoughts on this?
Yeah, from a pure technical standpoint, it could be viable for sure as a short, but you got to be careful. If someone does have a technical thesis on this to go short, and they have like, as an example, they go short at 153 on Monday, for example, and they have a stop at like 150, I don't know, 156, 157 even. Okay, that's their stop, but their profit target is around 147, 145. Okay, that's a good risk reward ratio. Okay, from a pure technical standpoint, that's a good risk reward ratio. Then they would have my blessing from a pure technical standpoint. But if they're looking at it from a fundamental standpoint, no. I mean, Walmart's a fantastic company. I really like it. One of my favorite companies. Um, and I'm always wary of shorting great companies, uh, especially if the market continues to go up. I can assure you, if the market continues to go up, Walmart will continue to do well because it's had a lot of relative strength as well. It's run up with the market, but it's also been doing really well the latter half of this year, whereas markets have kind of pulled back and been very volatile. Walmart's been kind of cruising upwards from May onwards, June onwards even. So that's a little bit more context for you, right? But good question there. From a solely technical standpoint, yeah, you could make the case for a short, especially with it being overbought. Maybe play the downside a bit, have a little bit of of a hedge uh, also from your long exposure stocks. But again, that's a different story.
Yeah, no, absolutely. Now, Tom made a comment earlier, said, might be the time to purchase a home. Now, I'm not going to give you any home buying recommendations or whether that makes sense for you. That's something that you'll need to take up with your financial advisor. But for me personally, I don't know about you, Riz, but home prices seem a little bit high right now. I don't know if I would be jumping in the home market right at
No,
this moment.
I agree with you. I wouldn't. I wouldn't. I'm not sure as to the context right there that Tom mentioned or the details. Obviously, I'm not privy to that. Um, and I'm not saying that Tom is wrong. Um, but just broadly speaking, I would hold off on buying a house just yet. I know it sounds absurd when I literally just put a deposit on a new build, but that's a very different situation. I'm not going to rehash that, but uh, generally speaking, if someone wants to buy a house, uh, you know, again, it depends on where you are geographically first and foremost. But generally speaking, in North America, I feel there is more downside to come in housing prices. Okay, all things equal, take it for what you want, but it's not real estate kind of advice. I'm not a real estate specialist or anything, nor will I do I pretend to be. Um, but that's my view. There is definitely some downside in housing prices in North America. Outside of North America, it's not really my purview.
Yeah, I was going to say here where I'm at in the Midwest in North America and in the United States specifically, prices are pretty ridiculous at the moment. I
Yeah,
think he was referring more towards the potential slowdown in interest rates, but I
yeah,
mean right now, man, I wouldn't want to take out a home loan if I could avoid it.
yeah. I wouldn't be rushing out to get a mortgage personally. I'm not. That doesn't apply to me, but for the
Sure.
average person, if they're looking to buy a place, I'm assuming they're going to be getting a mortgage at
Hmm.
these rates. They're in the 6%, 6.5%. When you compare them to 2 years ago, it's like a doubling, right? So it's great. It's crazy. That would not be going out to, I would be rushing. I mean, if someone needs to buy a home, they need to buy a home, it is what it is. But if someone is looking to get us investment property or looking to make that move, uh, I would rather hold off. And I can tell you that that's really been what's happening. The supply is low, demand is low. It's kind of like that kind of tug of war, but no side is making too much of an impact just yet. But I do feel like eventually it will be a buyer's market, meaning it will have you at some point there will be an opportunity for people to buy in at better prices than the start of the year. We've already seen that they have come down. They're still high. The prices have come down though, and that same thing applies to used cars, car market as well. So I feel like there's more downside for both cars and houses. And of course, even other luxury items like, watches and all that stuff have been plummeting too.
Oh, I agree with you, Nick. Nick's saying, any extra cash that people may have might be better to invest or pay down mortgage. Yeah, I agree. The more of the debt you can pay down and the more you can put in your trading account, the better off you'll be.
Absolutely. The way I look at debt, and there's some personal finance stuff, is think of the interest rate on debt, whether it's a credit card, whether it's a personal loan, whether it's a car loan, whether it's a mortgage. Look at the interest rate. And obviously, the highest one, without a doubt, will probably be credit card. So if people do carry credit card balance, I don't, but if people do carry one, um, that's the number one you want to tackle. You want to pay that down first. Why? That's the highest interest rate, most likely. You could be anywhere between 15, 20, even higher percent annualized. So the point I'm making is that 20% is the cost of borrowing. That is an expense. That's your cost. So by paying that down, you're essentially generating, or if you want to look at it a different way, you're saving yourself 20% expense. And as a result, I look at it this way: you're saving yourself 20%. You are generating a 20% return by just leaving, instead of just leaving that balance on there. And the way someone wants to look at it is, are you able to guarantee yourself a 20% return? Most people can't. So that's why by default, it always makes sense to pay down a high interest credit card, like 20% rate, which is not uncommon. The credit card rates here for a balance, carrying balance, is 20% here in Canada.
Yeah, it's pretty similar here in the United States. It just varies from company to company. But awesome. Well, I think I'm not seeing any more questions come in. Riz already told us kind of what he's looking at in the market this week. Obviously, we have the Fed decision here in about 10 days. Let's just kind of close on that because I think that's going to be kind of the big catalyst here in December. I don't think there's, unless something crazy happens, let's pray that that doesn't happen. With that Fed decision coming in for the rate hike, do you think if it is 50 basis points, do you think we see more downside in the market because people are unhappy because it wasn't as low as they thought, or do you think that that will be viewed mostly positively?
Yeah, a great question. This is tricky, and someone else actually asked me this too. I can't remember exactly when or where, but they said, you know what? What do we do with this? If it's 50 basis points, what if it's 70? It's a shock. 70 would be a shock, and I think the market would kind of go a little bit nuts if there was a 75 basis points, because it would go counter to what the Fed has said. It would go counter and be like, oh my God, the Fed was saying maybe we're gonna slow down, but they didn't. They're lying. Wouldn't be the first time, but then I think the market would be like, "Holy crap!" And most likely it would just puke. But I don't think that's going to happen. As far as a 25 or even a 50 basis point, which is most likely, I think that's neutral. That's a neutral decision. What happens there very much depends on what the Fed says after that announcement, right? They usually have a press conference, and they usually have minutes coming out the week after or whatnot. So that is what's going to be more important than just the 50 basis point. Now, if it's a 25 basis point hike, I think that could actually be bearish as well. And I'll tell you why. Because the market will interpret a 25 basis point hike as the Fed being even more cautious and not wanting to slow down the economy, or not having a hard landing, so to speak. Um, Again, a lot of these terms, that we see in kind of high finance, where hard landing means that the Fed is trying to slow down the economy, but not incur a very deep, very hard recession. A hard landing means that's exactly what happens. A Fed trying to cool down the economy, but in the end, it kind of slips into a bigger recession than anticipated, right? So that's known as a hard landing, and the market will be very, 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 I would say, stuck on this, on whether the economy slows reasonably and we're in kind of like a trough, or we end up in a big recession, um, and one that is a little bit more Fed induced, right? And that's a very, very moving target. It's like an SR-71 jet from the olden days moving so fast, and you're on, like, again, this might be out of the purview of others, but you have like a SAM, a missile, um, you know surface area missile system, not able to keep pace because things are moving so fast in regards to the economy coming down, and the Fed can't react fast enough. Then the market's going to be like, oh my God, the Fed, you guys overdid it. You guys, first of all, overdid it by not raising rates, and now you overdid it by raising rates too much. So that's the kind of pendulum that we're in, and it's so hard. It's so hard. You know, uh, it opens up opportunities as well, obviously, as we've seen. Um, anyone that kind of bought many of these companies earlier in the year is should be doing pretty well. Um, you know, uh, but I always say, let's not get too stuck in a thesis. Let's not, marry one direction or the other. Some people are too quick to be bullish or bearish. I like to play both sides.
Being flexible, that is the name of the game with this when you're trading in the market. And I think that's a very important skill to have, and be able to look at it both directions and not be, like you said, too hyper focused on one way or another, because that just lends you to, getting blown out if your thesis is wrong. So being flexible, being able to go both directions is a really great asset to have, and something that we should all strive for. Riz, thank you so much for coming out tonight. It was really great having you, getting your insight on what's going on in the markets. Obviously, these next couple weeks are going to be pretty important as we move closer and closer to 2023, and that should be an interesting year, to say the least.
Yeah, I will add, Chris,
Mhm.
that for those of you watching, again, thank you. For those of you that have joined Elite recently, awesome. Thank you so much for being on live, and obviously our OG members, um, and of course everyone watching outside of Elite in the recording. Please, whether you're in Elite or not, I will send a message in Elite. But for those of you on live and or watching the recording, please let me know directly, either by messaging me in our server with any feedback that you may have on these weekly webinars, whether we should add something, remove something, change something. I'm all ears. And for those of you that are watching the recording after, uh, please comment in the comment section below. Let me know. Let me and Chris know, what do you think we should add? What should we change? What do you like? What do you don't like? We're always open to feedback. Um, we're looking to see if there's anything we can make better, change. So absolutely look forward to hearing your feedback. Appreciate it. Thank you so much, everyone. Hopefully the next time I'm on, hopefully next week, we have some uh, good positive trades come through the pipeline, and we're setting up for a great holiday season.